Good morning, everybody, and welcome to the Daily Energy Markets podcast, where we have Brent crude oil trading up above $65 a barrel, up about 0.75% in early trading here in Asia after OPEC's decision yesterday, in which to from January to stop their cycle of supply increases, which of course have been going on now since April. OPEC have added close to 3 million barrels of oil a day. They will have by the end of the year. And with that, Brent crude oil price, despite all of the increases, has been averaging at around a little above $65 for the year. We're looking at on current target trajectory to finish the year at about $66, $67 Brent average for the year. Omar Najia, derivatives trader at BB Energy, good morning from ADIPEC 2025, where we had of the different headlines one might pull out of the early comments from the minister from the ADNOC CEO that OPEC, or that the world will be still consuming over 100 million barrels of oil a day beyond 2040. Hardly a surprising headline, but nonetheless, one to always bear in mind that this number, even if we don't continue to grow in global demand, is still a massive number, 100 plus million barrels a day beyond 2040. But Omar Najia, looking a little bit closer to hand, the next few weeks, few months, with this sort of decision by OPEC Plus to stop increasing from January and the added sanctions on Russian oil companies that we saw a few weeks ago, is this enough to sort of give this oil market an initiative to break out of this $65 Brent malaise it's been on for some months now?
And the answer is 110% yes. So basically, all I hear from everybody is, the US is going to invade Venezuela. That means that basically, after they invade, they're going to start exporting oil. Let's sell.
Is that before they invade Nigeria, or
exactly.
they'll wait?
And they're trying to do everything they can. I mean, the EIA comes out every day and says, we're revising up US production by 216,000 barrels a day and all this kind of stuff. It's so much. I mean, it's absolutely ridiculous. So basically, the EIA forecast in Q4, Brent would be at below $59, right? And Q1, Brent would be below 50. I mean, you have to have basically a hole in the head. So basically, EIA and all this kind of stuff, they have an agenda. They have an agenda. Why? Because the US has an agenda. They need lower oil prices. But this is not going to basically work. The lows on WTI, as I've been saying for a while, are in place, 55.12 and 55.30, and we are going to go a lot higher. Oil is cheap compared to anything out there. And they've thrown the kitchen sink at this stuff, and still we're not going down. We're not setting new lows. The market is holding. With all this stuff, OPEC, we're going to increase by this much. We're going to do a super increase by this much, and all this stuff. So at the end of the day, oil's the direction of the maximum pain direction is upwards. The market is short. Complete non-believers. The market's not going to rally. We're never going to rally. They're going to be la 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 la. This is the time to actually be long in terms of risk reward. Whatever people say in terms of, we're going to produce plus where all demand now is 107,000 million barrels a day. 107, right? And where's the investment in oil going to come from? Nowhere. Everything is going to go up in price.
Well, that was the other big takeaway from the ADIPEC opening comments this morning, were not so much the oil demand increase, but ultimately the energy demand increase, ultimately on the back of AI, with the quadrupling, get your head around that, of electricity demand by 2040. I mean, that is beyond scary what that looks like from the point of view, what is the raw material energy that will give you that electricity. Anup Singh, Global Head of Shipping Research at Oil Brokerage in Singapore. Anup, your thoughts? I mean, we seem to have been dancing for the last number of weeks, if not longer, with $65 more of a ceiling than a floor on this Brent crude oil price. Through the last few days and weeks, the sanctioning of Russian oil companies, now the OPEC decision, are we flipping that around? Is 65 Brent now a floor rather than a ceiling? Your thoughts? Anup, come in, Anup. Is Anup on mute? Am I on mute?
Yeah, I was on mute. Sorry for that.
You
yeah.
are on mute. Okay.
Yeah, I suspect that
I can be on mute, but you cannot be. You're the voice the world wants to listen to right now.
I love that. Well, the world. Then this is my opinion.
Yes.
Yeah. So I think there is an element of buying support also in the Brent price. It's so long as the Brent price is in a Goldilocks zone that the Chinese will buy to store, right? The OPEC decision can't really be that consequential because the volume we're talking about is really small. The big elephant in the room, or the big bull in the room, or the big reason what's supporting oil prices is basically Chinese still continuing to buy, and that's a function both of price is good, and in the future price could go up even further. It's the time to hold on to physical assets, trust fiat money. So stock oil for that purpose, yes, but also oil demand in China doesn't look to be doing too badly. If you just look at the National Bureau of Statistics numbers for refinery runs, right? Through the third quarter, June, July, August, September, even we are tracking refinery runs closer and closer to 2023 levels, which is about 1 million barrels per day more than 2024 levels. Yeah. Now, some of that is got to do with naphtha and naphtha demand, but 1 million barrels per day up on 2024, there's got to be a tailwind of underlying oil demand improvement. So I think you're going to look at what OPEC is doing, yeah. But I think the big story should remain really on how long will China continue to buy, and how much of it is going to be for storage versus how much is going to be for consumption, right? So we think I'd say for the sake of argument, 60% going into storage. So therefore, that demand becomes the most important metric to look at. Obviously, it's doing great for tanker markets. You got a lot of oil on water. So that's where we sit.
Just to clarify that point, 60% of what going into storage?
Yeah, 60% of the oil that the Chinese are buying. Yeah.
What? That can't be right. They buy 11 million barrels a day.
Incrementally. So incrementally, they're probably buying 1 million barrels per day more compared to last year. So 60-40.
Okay. Yeah. 60 of the incremental increase. Okay, gotcha.
Yeah.
Yan Chong, you're Director of Research at Wood Mackenzie. Your thoughts on this idea that we're flipping from 65 being a ceiling to 65 maybe being a floor? And you might add into that the idea that initial reports from Bloomberg today and others that the sanctions on Rosneft and the other Russian oil companies seems to be having an impact on Chinese appetite to buy from those companies, and so reducing their outlet. Your thoughts on that as a part of this this three-legged stool, i.e. OPEC stopping increasing from January, sanctions on Russia, storage in China, being enough to prop up the oil price, maybe move it towards 70 rather than 60?
Well, I mean, to begin with, I am still rather bearish, at least in the short term. Okay, if you look at Chinese demand up to this point, right? On average this year, the Chinese have imported about 11.25 million barrels per day. This is steady versus 24 versus 23, slightly more than 22, when they were just recovering from COVID, and of course, way more than 21, right? So despite everything saying the Chinese are buying, and despite the poor economy, which has been poor since 2023, they are buying sort of more or less the same levels. And I do agree that most of it has gone into storage, right? The thing is, how much storage do they have? It's not infinite. It is finite. We just don't know how much. What we do know is that they have had some new storage capacity that has come in, but nobody really knows exactly how much and how much has gone into storage. But what we do know from looking at what they are refining, right? So in terms of the refining capacity, in terms of the throughput that they have to run, it's averaging about 77, 78%. And this is also sort of steady versus 24, which was about 75, 76%, and 23, which was 78, 79%. So in other words, I would say that the throughput is there or thereabouts. There's no, and the Chinese economy is still not great, right? They have this new 15th five-year plan that's going to be announced in the next 1-2 months. And the expectation is that they will try to stimulate the economy as they have been doing, but not overly aggressively. They're looking at GDP for next year of about 4.6, 4.5%, which is what we at WoodMac are forecasting, right? So that's one, right? Two, the impact on the sanctions on Rosneft and Lukoil would actually, in my opinion, affect more Indian demand than Chinese demand, simply because we're already starting to see some Indian refiners saying, right, when I think about this, let's buy something else. We have also seen Turkish demand going away from Russian. They used to be buying like 100% Russian crude. But today, there's a news that came up today where they were buying some
But
Iraqi oil.
if one takes that point, is that bearish or bullish for oil prices? Ultimately, if you are able to stop these countries from buying the Russian oil, or at least reduce their purchase of Russian oil, does that make the market? Does it impact the structure of the market?
Okay, so that's the route, right? Basically, I would expect if the Indians to buy less, the Chinese to buy more. Because bear in mind, the Chinese that are buying Russian are largely the teapots, the private refiners, right? At least overtly, the big boys don't touch Russian oil. They don't, just as they don't touch Iranian or Venezuelan, right? So we know most of the sanctioned barrels are going into Shandong, right? And the US sanctioned Yulong, which is a big Chinese refiner. They are about capacity about 400,000 barrels a day. They came on stream end of last year. They were sanctioned. There was a boat of Middle East crude heading there. Just as they reached port, the sanctions came in, the boat turned away. And they ended up buying more Russian crude. Right? So
let's bring Omar back into this conversation, where the bull in the group. Omar, your bullishness from the point of view of the fundamentals or of liquidity and flows. If we look at what happened in October, significant sell-off of Bitcoin and gold reached records through the month of October, and then it seems some serious profit taking. And so a lot of new liquidity may be looking for a home. Your thoughts on the fundamentals for your bullish view that it's the flows of investment dollars available versus the fundamentals of supply and demand?
So we have like lots of companies, not Wood Mackenzie, but say Kepler, Energy Aspects, blah, blah, blah. And they all come and they all say like, this 2.7 and it's going to be a tsunami and we're going to see 3 million barrels. I don't know what, blah, 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 right? They've been selling that since crude went to $56, right? Then what happened? It went from 56 to 61. And they're still selling the same stuff. They're still selling the same stuff. Now, I don't believe that they're basically, lying. I just believe that the market doesn't work on supply and demand and adding things up. I wish it was that easy. I wish I could say there's +2 supply and -3 demand, and therefore I'm going to buy. Doesn't work like that. Doesn't work like that. So what's happened now psychologically? Everybody who's been listening to basically a tsunami is coming. We're going to get so much supply. We're going to go to $50 Brent. What's happened? They've not only been, chopped up into little pieces, they've also been toasted, microwaved, and boiled. They're gone. You're not going to see them come back. They're not going to short. They're not going to short because the idea is exactly the same one that they've been talking about when the market was $6 lower. It's gone. You can forget it. So you've had a sea change in terms of sentiment and in terms of what the market is focusing on. The market isn't focusing on a tsunami because it's not here. And they can keep pointing and saying, it's coming over the horizon. You can see it.
Well, I think hasn't OPEC just taken it away by saying they're not going to be increasing anymore? I mean,
no, because they're talking about a 3 million barrels a day tsunami. They're talking massive numbers. So the market isn't validating their point. The market looked at it and said, no, thank you. So
well, let's bring in Anoop there. Just on that point, are we seeing that in the shipping, Anoop? Are we seeing the fact that there is, a lot of floating storage, that these ships are actually not on their destination to somewhere, they're just sitting? What's shipping telling us about where truth is at the moment?
From where we sit, Sean, there is a lot of oil on the water. How much of it is sold and how much of it is unsold is unknown. So I think, so oil, the way I look at it, oil from a flows perspective, it is a flow variable, right? So there's more oil on the water. If that oil gets absorbed, it's going to be, because there is so much oil being produced. If that oil on the water gets absorbed, eventually it reaches ashore, goes into tanks, and it's replaced by another big tranche of oil being exported. Yeah, eventually we're going to overwhelm available sources of storage, and therefore we might get into the space where Omar is talking about, which won't come. Omar's argument is it won't come. My argument is that it could come if this current tranche of oil, as it flows through the process, all on the water.
Do we have a number on that? Do we have a number of what we're talking about? I've heard 1 billion barrels currently on water.
Oh, incrementally, we have about 100 million barrels more than same time last year. So if you compare today versus the last year, 24, we had about 100 million barrels more oil on the water, excluding barrels which are sanctioned. So from a shipping standpoint, I don't look at Iranian oil, right? But if I exclude that, so we are 100 million barrels above. 100 million barrels, there is some storage for it. Globally, even if you just look at what was the last high point we set, we are about 200 to 300 million barrels short of the high point that we set in 2020 for known onshore storage, right? So if this oil finds a home, because there is more supply than the world needs, from where we sit, that oil is going to replace this current oil on the water. So eventually we're going to get to a point, unless, this is all very dynamic. I'm painting a picture of as is. But if you lose Russian oil, if demand is a lot stronger than the likes of voices like us are talking about, then again we will not have the need for that much oil to sit on the water. It'll go into your cars and motorcycles, right? So it's dynamic. A lot of things could change. Demand likely comes in stronger than where the IEA sits at. Right? IEA is talking about a very low number. EIA, OPEC are twice IEA's numbers. So if you put that, if you say, well, demand is higher, and let's say you lose 500,000 barrels a day of Russian oil, crude, because Indians are rejecting it and the Chinese are not buying it all, then the oversupply starts to shrink.
But an oversupply nonetheless. Yang Chong, I wanted to get your thoughts. Again, you mentioned earlier that your views were sort of more on the short term bearish, that it might change as you go out the curve a little bit. Tell us a bit about that, and in that, what did you hear anything in the Chinese 5-year plan that was announced at the end of last week that would indicate a more bullish outlook for China, given what they said in that plan, 2026 to 30?
Okay. I mean, actually, funny you should say that I was in China just a week ago. Okay. And I was meeting up with some of these guys that are doing the teapot business, right? And basically, they were all screaming in pain because domestic demand is not great. So margins are not great, right? And because that's not great, and on top of that, they have had additional taxes or reduced rebates on straight run fuel oil, which is their preferred feedstock if they don't have a crude import quota, right? So, and these guys are telling me, look, they know there are plenty of Iranians on the water around them. They don't know exactly how much, but it's all around them, and nobody's taking it unless like the seller drop their pants. Okay, so that's the situation there on the ground in Shandong.
Well,
right?
our analyst in Iran is telling us that the pants are being dropped. That's a big problem in Iran. They're $10 plus below Brent.
Well, I mean, as far as Chinese concerned, not low enough, man.
Whoa, Jesus, don't get
Because
greedy, man.
because they also have too much. They also have too much oil, right? And
Right.
the problem is the margins are not there, right? Yeah, so that's the problem in China right now, and they don't see this situation changing anytime soon. Soon, short term, right? They are hoping that the government could increase the rebates again, because they actually cut the rebates at the start of this year for fuel oil, right? So a lot of these guys who can't buy crude actually want to try to buy crude through some other party that has a crude quota. Yeah, but even then, they have too much. Okay, and they can't export anyway, right? And the Chinese are not exporting big time anyway. Yeah.
Yeah, they're clearly backed away from that trade. Let's go to the survey question here. The OPEC Plus announcement yesterday to suspend oil supply increases from January. So they're going to continue next month with another 100 plus relatively irrelevant amount. But on top of what will make for the whole year a close to 3 million barrel a day increase in oil quotas, at least. How much of that is tangible barrels in the marketplace? There's some debate, but ultimately it's a close to 3 million barrel a day increase in quotas. I think that's the important point as to where I want to talk next. But on top of further sanctions against the Russian exporters, the Russian companies that we saw last month by the Americans and the Europeans, will drive Brent crude to $70 by year end. Those two things, agree or disagree? Again, it's sort of building on this thesis that 65 Brent is now a floor, not a ceiling, as it has been most of the third quarter and into the fourth quarter of October. Now it's shifted. And these two big events, OPEC Plus announcement to stop increasing for January, plus the Russian increased sanctions, is enough that will drive Brent crude oil to $70 on Brent by the year end. Agree or disagree with that thesis? The idea there, Omar, ultimately, from the point of view of sentiment and flows, the U.S. markets, equity markets, continue to reach records. We've got the Fed giving more and more punch in the punch bowl. Your thoughts on the risk on versus risk off appetite going into the end of the year, into the new year, and where does commodities and Brent crude fall into that, either risk on or risk off bullish appetite of the general financial markets?
So I tend to kind of, look at oil as not being an island and trading by itself in a world where it's disconnected from the entire planet and financial markets and all this kind of stuff.
Although it looks a little bit that way in a way this year, doesn't it? I mean, it didn't enjoy the crazy bull run of everything else.
Yeah, basically oil is the most geopolitically driven commodity that exists. It's also the largest one. apart from gold, I think. I'm not sure. I think gold is, I'm not sure actually which is going to get. Anyway, so the point is that oil doesn't trade in a vacuum. Oil trades relative to everything else. And yes, any asset can basically diverge from other assets for a long period of time. But eventually it comes back, right? So all you've got to think about is, you don't need to look at like, how much plus is this and what OPEC's going to do. You just need to look at that divergence. It's been diverging for a long time. When did oil catch a bid? When gold dropped. Is it a coincidence basically that people rotated out of gold and bought oil? I don't think so. People will say, oh, it's unrelated and all this kind of stuff. I think it's very much related. So all I'm telling you is that when I look and I see NVIDIA's a $5 trillion company and gold is trading at whatever it is, $4,000 and all this kind of stuff. When I see basically that inflation is rampant and the Fed is basically going to cut interest rates, adding to liquidity, right? The last thing I'm going to do is look at something that is extremely cheap, in fact, probably cheaper than it's ever been. And the only thing that hasn't basically moved higher since the highs we saw in 2022 or 2023, and think to myself, you know what, on a strategic basis, that's the asset I want to sell. I mean, it's simple. You don't have to get overcomplicated. So no, we will not be selling basically oil and going short oil in the hope that we hit the bottom and get a shovel out and start digging. No, I'll take the other side of that trade.
Anup, taking and sort of underpinning Omar's views, but again, the fundamentals that we talked about, OPEC Plus's decision yesterday to stop increasing from January is really not a decision of sorts, in the sense that, again, coming back to my point on the survey, that the OPEC Plus increased their quotas by 3 million barrels, or close to 3 million barrels this year. But the reality is nobody's left in the group that can actually increase production. I mean, Russia is getting shut in, never mind increasing. All of the other producers, other than Saudi and the UAE, really don't have any barrels left to add to the market. I mean, you can keep giving them quota paper increases, but there just isn't the idle supply there anymore. Your thoughts on that factor playing a role in this decision and how it impacts the market going forward?
Yeah, fair. Out of the G8 countries, you could possibly talk about them as G7 now, because Russia is, as you had earlier argued, possibly losing supply. Out of the G7, yeah, Saudi Arabia has some, UAE has some, Iraq has very little, yeah, probably 300-400 KBD. So quotas. So I guess the only two countries which can increase production proper, yeah, is Saudi Arabia and Iraq. But what's interesting also is that the overproducers who are not complying to quotas, it's not as if they have improved their compliance much, except perhaps UAE to some extent, right? So that overproduction also remains in play. And so essentially the quotas are basically catching up with the actual levels of production, right? All said, yeah, we've sort of counted out of the 3 million, actually 2.25 million barrels per day of increased quotas up until September. That came with about 1.7 million barrels per day of real barrels, right? So there was this catch up available during the previous phase of unwind. Subsequent phase of unwind, unless there is a massive change in baselines where Saudi Arabia and the UAE go to the OPEC and say, well, we've got the spare production capacity and we increase baselines. Yeah, we increase supply. Yeah, other than that, not much available in the tank for the others. Yeah.
Yan-Chong, last word to you. Obviously, so disagree is 2-1 at this room, at least. Fair enough. Woodmac sits obviously at the coalface of providing data and intelligence to the upstream industry, and so have some window on how busy is the upstream industry adding new supply capacity from the point of view of taking opportunity here. Where's the future supply outlook? What's your crystal ball telling us? The way that Anup Singh watching all those ships, he told us what his crystal ball is telling him. But what's your crystal ball at the front end of Woodmac's view on oil services companies being busy, very busy, not so busy? Your thoughts on that?
To begin with, I think our expectation is that US production will probably stagnate from here. We expect year-on-year growth to be flat and to 2026 and 2027, maybe even a reduction. So, but the growth that's coming in from the Americas, we expect to mostly come from Latin America, from Brazil and Guyana in particular, at about 500,000 barrels a day for next year, right? The rest of the world, well, I mean, Russia, I was just going to think about this, right? Russia, it depends on what they do after the sanctions and how demand goes, right? If they continue to produce as much as they are, then they have to find homes for the oil, and that would be bearish. But if they cut production, then it depends on how much they cut and what happens after that. How does that affect global supply demand, right? So that remains to be seen. Elsewhere, we don't see any big plans to increase production. The Middle East will be as they are. As you have said, we don't see a lot of spare capacity in the Middle East beyond the Saudis and the Emiratis. And that, in my mind, is actually a risk. If there's a big disruption anywhere in the world, then that cushion of spare capacity is fairly limited, right? So,
and I think that's where that's where the rocket to the upside could come. And if there is a black swan event of some description, and there's suddenly a call on a significant amount of oil, 1 million barrels, that could certainly put a shock into the market. This market is tighter on the idle supply capacity than it was 6 months ago, clearly, and I'm not sure the market's quite adapted to that reality that we have. We went from a diluted space of perceiving the world to have 5 or 6 million barrels of idle capacity, even if that was true 6 months ago, and I don't think it was true 6 months ago. But it's now less true with 3 million barrels of quota production increase from OPEC plus. So there is something in that needs a bit of attention, I would say. The other thing that I would say that needs a bit of attention from what I'm hearing at ADIPEC this morning, the massive call on electricity demand over the next decade, priced into, as we're seeing it, as I think Omar mentioned, $5 trillion on NVIDIA, valuation company, based on one very, very critical premise that NVIDIA and all of its customers are going to get the electricity demand they need for all of the electricity supply, rather, to realize that valuation of $5 trillion. I think there's a big gap somewhere in the fence here, that the supply of the energy demand that is being called on, it just doesn't make sense. It's not in oil, right? The oil isn't going to do it. Gas isn't going to do it. It takes 10 years to build a nuclear power plant. So there's some big gap here in that bigger question that sort of surfaced this morning here at ADIPEC. We'll leave it there. Brent crude oil, little changed would have to be said after the OPEC Plus announcement that they are going to stop increasing from January. A 50-cent up swing this morning in Asia, not exactly a rocket. We'll see. I think this market is addicted to $65 on Brent, and it seems, I've said it a few times, whatever the question, the answer is still $65 on Brent. Yang Chang Yaw, lovely to have you this morning from Singapore. Anup Singh, the Singapore twins, thank you so much. And of course, not Monday morning isn't Monday morning unless Omar Najia is in the chair. Thank you, Omar, for all your insights this morning. Have a great day and week, everybody. Best regards from ADIPEC 25.
Bye-bye.
All the best.
Bye-bye.
Thank you.
Bye.
Thank you.
Bye-bye.
Thank you.
Bye.
Thank you.